Hi, I'm Mike Riley. I've originated mortgage loans in Orlando, Florida for 32 years. And today I'd like to talk to you about money needed at closing. Too often I'll get a phone call from a buyer who I've never spoken with before. They're already under contract, and I tell them, hey, here's how much money you're going to need to buy this house, and here's what your payment's going to be. And a lot of people say, I had no idea I needed that much money. Well, the time to have that conversation is before they go under contract, not after they're under contract. So today I kind of wanted to walk you through the math and on a typical $400,000 single family house. So probably the biggest misconception out there with buyers is they think that down payment equals money needed at closing, and it doesn't. It can mean that, but it does not necessarily mean that. Those are not equal, all right? Money needed is not equal to down payment. Down payment is just one of three categories of money needed at closing, so let's walk through those three categories. How much do people need to put down? Well, the answer, as it is with most mortgage questions, is it depends. If somebody's a veteran of the U.S. military, or if somebody's buying a rural property as defined by the USDA, then they don't have to put any money down. If somebody's getting an FHA loan, which is typically for people under a 680 credit score most of the time, then they have to put down 3.5%, which is on a $400,000 house. That's $14,000 down. For somebody with higher credit scores, typically defined as over 680, and they're getting a conventional loan, then usually they have to put down 5%. There are some exceptions to that, but let's say 5% down, and then their down payment would be $20,000. So right there, how much money does somebody need to buy a house? Only with the first category, there could be a $20,000 difference between a VA loan and a conventional loan. The second category are closing costs. Closing costs can vary a little bit. For example, if somebody's buying a 20-acre parcel out in Geneva, the survey could be a couple $1,000s easily. Or if somebody buys in one of the few counties in Florida that require the buyer to pay the lion's share of the closing costs, then the closing costs could be higher as well. But for the most part, assuming that the buyer pays no points, then the buyer's going to need about $7,000 in closing cost money. Now that's a huge assumption right now, because this again is assuming that the buyer does not want to pay points. The buyer doesn't need to pay points. The buyer can voluntarily pay points. They can pay extra money on top of this $7,000 to buy themselves a lower mortgage rate. Sometimes that makes sense, sometimes that doesn't. It's my job to explain all of that to the customer and let them decide what they want to do. But as for our math today, we're just assuming no points. The third category is called prepaids and escrows. Those terms are interchangeable, and there's four subcategories of those. People are going to need to start out with some money for property taxes in their escrow account on their new loan. It's still their money, but it's reserved for future property tax bills. People are going to need to pay their homeowner's insurance in advance for a year. I can look up the age of the roof, the age of the house, the type of construction, and make what is usually a pretty good estimate. But the insurance is going to be a lot more on a 100-year-old wood frame house than it is on a 9-year-old block house, of course. Interest, that's interest from the closing date through the end of the month. A lot of people want to close at the end of the month because it's cheaper interest-wise in their prepaids, which is true. They're that much closer to their first mortgage payment, so it kind of balances out in the end. But as far as money needed at closing, it does minimize their money needed at closing if they close towards the end of a month. And the big one is HOA dues. Some houses are in an HOA, obviously, some are not. Some HOAs require a very large capital contribution. I've seen it be a couple $1,000s at times. Usually it's a few $100s, but the HOA will also make the buyer pay anywhere from a month to 6 months in advance at closing in most cases. So this number for prepaids and escrows, it depends on a lot. It depends on the tax bill, the homeowner's insurance quote, what time of the month we close, and whether there's an HOA and what the HOA charges are. So this number could be about $5,000, but there is a lot of play in that. If somebody gave me an address and said, hey Mike, here's the address, I can look up the taxes, I can see how old the roof is, I can estimate the homeowner's insurance, I can ask what time of the month we're closing to firm up this number, and I can ask, hey, has anyone asked the HOA what their fees are going to be at closing? So I can fine tune this number. This number could be as low as $3,000, it could be as much as $9,000 in some cases. But for the most part, if somebody said, hey Mike, how much money do I need to close? I'd say, well, it depends. If you're a veteran and you're paying your own closing costs and prepaids, you're going to need about $12,000. If you are not a veteran and have good credit and are getting a conventional loan, then you're going to need $20,000 down plus this $12,000, so roughly $32,000. But there's one big caveat to all of this, because at the bottom, there are two potential very large credits that people can get. They can structure the offer so that they ask for a seller concession so that the seller pays some of their closing costs or prepaids for them. The seller cannot pay the down payment, but the seller can pay either of categories 2 and 3. And I can often get people down payment assistance in the state of Florida, usually about $10,000 for first-time buyers, and we can talk about that more in a separate conversation. For example, if somebody's buying a $400,000 house and they qualify for down payment assistance, well, Mike, how much money do they need? Well, they need $14,000 plus this $12,000 is $26,000. But if I'm getting them $10,000 in assistance, then it's down to $16,000 that they would need. And if we get them a $10,000 seller credit, because their offers sales price wise is a good one, then they may only need $6,000 total out of their own pocket. So a lot of times on these down payment assistance loans, I can structure the deal where people need just a few $1,000s out of their own pocket if they make a good offer. So again, money needed does not equal down payment, and that's where this goes off the rails all the time. So call me before your buyer signs an offer, and we'll do a quick calculation. It's a 2-minute calculation for me. That way they know, hey, if this offer is accepted, here's how much money I need. We'll want to know that for 2 reasons. Number one, to make sure that they have the money, and just as importantly, we'll want to make sure that they're comfortable with bringing that amount of money. We'll also talk about monthly payment, which we'll do in a separate video, but that's it for now. Thanks.